This is part 2 of our chapter 2 video lecture where we're covering 179 depreciation, bonus depreciation, also some limitations to depreciation, amortization, and depletion. So our textbook has quite a few examples of 179. So I'm not going to go into the details, but just cover the general rules. For 2018, the tax laws allow up to $1 million of capitalized personal property to be written off, to be deducted in the year you put it to use, instead of going through that maker's depreciation, deducting it over the useful life like we covered back in the first video. Okay. Now, one of the limitations here is once you buy more than 2.5 million of personal property during the year, this $1 million limit starts to go down dollar for dollar. So if you buy 3.5 million dollars of personal property or more during the year, then your 179 deduction is zero. And now you have to use maybe the bonus depreciation, which we'll see in the next slide, or go back to that maker's depreciation we had calculated back in the first video. Another limitation for 179 deductions is that it cannot create a business loss. So here's your business income, and here is your business deductions, which includes the 179 depreciation expense. So the amount you can put here for 179 cannot reduce your profit below zero. But one of the nice things about this limitation is that included in this revenue can be any wage income you earn from another job, from another activity. So you can increase or beef this up, yeah, going over the limit. Now, whatever you do try to claim in the year that you cannot use, you can carry it over to the following year, subject to the same limitation. Okay, you don't carry it back, but you carry it forward to future years. So this is quite a good deal here for this 179 calculation. Let's take a look at bonus depreciation. So let's say that you have more than that $1 million of personal property being bought, or you're subject to a limitation. Well, here for 2018 and all the way up to 2022, you get to deduct 100% of that personal business property you put into service. Okay, this is really a game changer for a lot of people. You don't have to go through that maker's calculation and depreciation over the years. But once we hit this 2022, this limit starts to phase down. Okay, so maybe makers will come back into play in a future year. Another thing about this bonus depreciation that it can create a business loss. Again, you have revenue and you're minusing out the expenses, which includes this bonus depreciation, and you can create a loss. We'll talk about a business loss called a net operating loss that you now, under current law, cannot carry back to a previous year and claim a refund, but you're going to be carrying it forward to future years, subject to a new 80% taxable income limitation. So we'll probably see this calculation in a future chapter. Okay, so that's more depreciation under 179 and this bonus, in addition to the makers we had seen in chapter 1. Now let's talk about some limitations to the depreciation deduction. Some types of assets are classified as listed property when the property has some type of recreational or personal nature to it. The government tries to limit the amount that can be deducted. So if you have a so-called mixed use, when an asset is both used for business and personal, we only can deduct or depreciate the business portion. And if you have more than 50% business use, let's say you have 60%, that means you get to depreciate that 60% under makers, or maybe the 179, or maybe the bonus. Now, what gets a little tricky is if that business use is equal to or less than 50%, you still get a deduction, but now that amount, let's say 40%, you cannot use the double declining or the 179. You have to use straight line depreciation, probably over a longer life than that 5 or 7 or so forth years we've seen for normal makers depreciation. Okay, so the type of property that comes under this listed category are things like automobiles, computers, things that have maybe a recreational, personal nature to it. So the way you can probably get around this is you strictly use, let's say, one automobile for business and one automobile for personal, or one computer for business and another for personal. Of course, a lot of us can't afford to have two of everything, so we probably are subject to this type of allocation. And the key amount is this more than 50%, where you still have to do a business allocation, but now you still can use those depreciation methods we talked about for that smaller percentage. Once the percent hits 50 or less, things start to get really tight in terms of deductions. Yeah, under the straight line and longer lives. Another limitation, in addition to listed property, is automobiles again considered to be luxury category where they're going to limit the dollar amount of the depreciation. Now, in past years, like 2017, these were the maximum amounts of depreciation in the first and so forth years. No matter if you have a big expensive car or a small car, cheap car. And even though the word is luxury here, a car under 20,000, mid 20s, could hit this limit very easily and not really be a luxury but still be capped at that dollar amount. The cap has increased dramatically in 2018, in addition to bonus, which is also capped at this amount, so possibly a maximum of 18,000. Okay, so you go through your regular depreciation calculation, bonus limited to this, 179 makers. But here is the max for makers and 179. Here's the max for bonus for the first year. Here's the max for the second year and third year and so forth. Okay, so that's a cap dollar amount for automobile depreciation. Let's talk about amortization. Now we've already depreciated tangible property. Now we're talking about intangible assets being used up. And intangible assets can be categorized into four different groups. So let's say that you buy a whole business. Now typically you don't say I want to pay this for this specific piece of furniture and this computer, this dollar amount. You just give one lump sum for the whole business. So in that lump sum, you allocate the cost to tangible assets like land, building, personal property. And anything else that you cannot identify that you paid for is considered to be an intangible Section 197. Things like that infamous goodwill that you learned in financial accounting, or most times when you buy a professional practice like a doctor, a dentist, even a CPA, a lawyer, what you really are buying is not the office, not the equipment. You really are buying their clients, the contacts, a patient list. Okay, and that has value. That's an intangible asset that's going to be amortized. If you start up your own business and not buy one, you may have to capitalize that investigation cost, the startup costs, the incorporation, the forming a partnership costs, and then amortize that cost. Research and development costs, just like financial accounting, you can write it off right away. But for tax purposes, you can choose or you can elect to capitalize it for less than 60 months. Patent and copyrights, you just amortize it over the remaining life. So here's a summary of that amortization rules. When you buy a business, the assets that you are not physical, are not tangible, you're going to amortize the cost over 180 months using the straight line. Amortization is always straight line. This is a comparison of financial accounting. Yeah, the infamous impairment. Yeah, and then startup costs for new businesses. This is buying an old business, right? And here you're forming a new or investigating a new line of business. All the costs you incur before starting opening your doors, you amortize it over 180 months. Research and development, again, you can write it off, just like financial purposes. Otherwise, you can capitalize it for no more than 60 months. Patent and copyrights, you just amortize it over the remaining life. Amortization, again, using straight line method. Let's talk about depletion. Okay, we're looking at natural resources that the business owns that's going to be extracted, mined, harvested. So what we do is look at the cost of this natural resource and divide it by how much it represents in terms of unharvested, unmined resources, or here called reserves, to get the cost of one, let's say, ounce of gold, or one barrel of oil, or one uh, foot of lumber. Okay. And then we multiply that cost by how much we harvest, we extract each year to get the depletion deduction. So let's take a look at an example here. We have Scrap Happy again. They're buying some land with a forest on it, and that land cost 75,000, and the lumber, the timber, is allocated 60,000 of value and 15 to the land. Again, we know we cannot deduct or depreciate, or in this case deplete the land costs. So we're going to deduct the $60,000 of timber costs over the time we harvest the timber. We figure out there's a reserve of 30,000 board feet. So in other words, we paid $2 for every board feet. Every time we chop down 2 feet of timber, we're going to claim a $2 depletion deduction, or when we sell um, that lumber. In our case here, again, total cost allocated to the timber divided by that reserve, or how much we estimate we're going to harvest, to get the cost of one unit. And we extracted during the year this amount of units. So we multiply that output times the unit cost to get the depletion we're going to claim for that year. So next year's output times the same unit cost gives us next year's depletion. Now you cannot claim more than 60,000 over the life of this timber, right? Now if you were dealing with an extraction of a mine, of a natural resource, like these items here, rocks, metal, oil. Once you use up your costs, now you can start using something called percent depletion. These businesses have such a good lobby, they can actually make deductions out of thin air. In other words, once you use up all of that um, oil and gas costs you allocated to buying that oil well, you can take a 15% deduction for the gas you sell, the oil you pump out. Okay, and this is more than the cost you paid for it. Okay, that's called percent depletion, an artificial deduction for people that have natural resources. And you can see again the percentages here for these types of minerals being extracted. Okay, that's it for part 2, rather short video. I'll come up with one more video showing you how to fill out form 4562 to claim the depreciation and the amortization deduction.